Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. If you were watching Dan and I talk last week, and again, he has a playlist. At the end of video number 2, we talked about I'm building a shopping list. Months and months and months ago, I said I'd be a buyer at 3,200. It looks like we may get there. I've already executed my first trade, so we will look at that company. But Dan's gracious enough to listen to my 10 stocks that are just on a shopping list. I've only bought one of them. Or I guess technically I bought 2 of them. This is just Michael Zuber doing crazy things, not financial advice, but Dan said he would give me feedback on my 10 stocks. You ready?
Yeah, and by the way, the other thing that I mentioned was we can look at my risk calculator. We'll look at the JP Morgan that you bought.
Sure. Yeah.
And see how many shares you should buy. You're probably not fully invested in it yet, but
nope.
We'll see how many you should buy. And we'll actually show you how the calculator works.
Okay, we'll do JP.
There's a lot to it, so we'll just do it from a high level. So
yeah, so we'll do JP Morgan last. So let's go through the other 9 stocks, just charts.
Okay,
and then
we'll
do JP Morgan last. Okay.
Yeah. Yeah.
All right. You want to take over the screen?
Yeah. Hang on one second. Let me get my chart. I'll put. What's the first one?
Chevron.
Chevron.
Mm-hmm.
CVN. Nope, that's Carvana.
CVX.
CVX.
I think.
CVX is Chevron, yes. All right. Let me share my screen. Okay, you see it here?
I can. Yep.
All right, so this is my default view. It's basically a 7-month view. Mm-hmm. This is the actual price right here in the middle. Yep. So I use a 50-day moving average, which is the red area, below the red area, or at the red area. It's 50-day moving average. Mm-hmm. The next one is the 21-day, which is reversion to the mean. That's where stocks like to come back to and either go through it or get rejected, go back down. And then the last one is the 8-day moving average, which gives me a faster view of how it's moving. So that's what that part looks like. The part at the top is the relative strength index. This is a momentum indicator. When it gets to 70, that usually means it's overbought. That means it may experience a decline. May, doesn't mean it always will. And when it gets to 30 at the bottom, it means it's oversold, which means it's getting ready for a bounce. It can stay at those levels for a while, by the way. So if you look down here between June and mid-July, the RSI was down here close to 30 that whole time. Mm-hmm. So these are just, you never base a entry or an exit on one indicator. Right. You have to look at all of the evidence. Okay. This one in the middle is just for interesting information. It's basically a weekly. So is it declining or going up on a weekly basis? Mm-hmm. You can see here it's just started on a weekly basis, starting to go up. So that's good. Very cool. And then the PPO is also a momentum indicator. So you want to see this moving up. And then these down here show you what the stock is doing versus what its industry group is doing. So the red one is the industry group. How is it doing? And this is oil. So the red one is oil. The blue one is how is Chevron doing versus the rest of its own peer group. So how is it performing versus its peers? And you can see right here in the oil group, it's underperforming its peers right now. Yep. The one below that is how is the oil industry performing versus its sector. Sector is the energy sector. The oil group is basically keeping up with the rest of the energy sector. Mm-hmm. Then the one at the bottom is how is energy doing versus the S&P in general. Right. And as we all know, energy has been dramatically higher. So the energy sector has been outperforming the S&P. The oil industry inside of the energy sector has been sort of keeping up. Mm-hmm. Chevron has been underperforming its peers in its own industry. Got it. All right. So I put those on there. I explained them, but what I do is I just very quickly glance at them. So they can give me red flags sometimes. Like if I glance at this, I'm like, I'm in the right sector. The industry is okay. Looks like the industry itself is taking off, but Chevron isn't really outperforming its peers. Okay. So it's one that I probably would pass on
Okay, great.
myself, just based on that.
No problem.
But you know, there's lots of different reasons why you buy a stock. So if you're a long-term investor, you also want to look at dividends and holding something for a long period of time. All right, so this is the first one I look at, is the default. The second thing I will look at is the long-term weekly. So how is it looking over a 5-year period? And what I see from this is it's starting to bounce at support. So from a timing perspective, it looks like a good time to be in. The accumulation distribution, which tells me if institutions are accumulating this or not, looks really strong. So institutions are definitely accumulating Chevron. And it also tells me that up here is where resistance is, at 175, 180.
Okay.
So if you're holding it for the long term, this probably would be a good time to get in. But you have to watch it when it gets to 175 and 180 and then make a decision if you want to continue to hold it or sell it and buy back in later. If you're a long-term investor, you just hold it forever.
Yeah. For me, it's it's one of the yield plays for me.
Yeah.
I'm a boring old investor, so not a trader, not a trader. Okay, so that's the first one. Again, these are just lists I'm looking at. These are not things I will buy, guaranteed to buy anything. It's not financial advice. It's just 10 companies I wanted Dan to look at. So
the other thing I noticed, and with the long-term chart like this, you should always look at a short-term and a medium-term and a long-term. Medium-term being a daily chart over 7 to 12 months. This was a 5-year chart. It's a weekly, so each one of these bars represents 1 week. See, these Chevron has just started to take off again. It's always good to, if you have a list like that you're watching, it's always good to watch it and see when it comes down to its 21-day moving average. Okay. So with Chevron, you know, it looks like it's starting to decline here. So now you can make a decision. You can do number one, probably makes sense for you, especially if we hit 3,200. If we hit 3,200, this is probably going to come down here anyway. But number one, you could just ladder into it. So buy your first tranche and then wait and watch it. And if you're watching it, wait till it comes back down to the 21-day and buy some more right there. Got it. Okay, we'll look at the risk calculator for JP Morgan at the end, and I'll explain some of this stuff. Oh, all right. But again, you can see the resistance up here. Now this is a 7-month chart. Right. You see up here at 180. Yeah. This shows you the value of looking at a long-term chart. So if I'm looking at this, I'm saying, okay, it made it to 180. That's resistance. It probably could make it back to 180 again, and maybe it will blow through 180. Right. But what does it look like on a 5-year chart? It's never been higher than 180. Got it. Never. Right. So what are the chances it's really going to blow through there? Now, if it does, it's got blue skies ahead, right? But the likelihood is that a lot of people that bought over in this period, and then saw all of their profits evaporate through this, you know, down cycle right here. They become sellers. Yeah. They'll become sellers up here, and this will become another resistance level. Got it. Okay. That's the value, and that's a good thing about this particular session. It's the value of looking at both a medium-term daily chart as well as a long-term weekly chart. Very cool. Number 2 is Caterpillar. Caterpillar. So here's the daily chart. It's it hasn't gotten above its weekly right there. It's right at the 21, so that's reversion to the mean. So now the thing you got to watch for is it going to get rejected there? So the 50-day is above it, so it still needs to get through that resistance of the 50, and the 200-day is above that. Okay. Remember when I in a session a couple of weeks ago, I showed Paul Tudor Jones's trading rules. His number 1 rule: always be with the predominant trend. My metric for everything is the 200-day moving average. So it's not above its 200-day. So Caterpillar could very likely get a rally to the 200-day and then get rejected again. So again, if you want to ladder into this one, right now might be a good time for your first tranche. Okay. And then wait and see what it does. Is it going to get through the 50? If it does, you want to buy some more as soon as it closes above the 50. And then you want to see what it does at the 200. Got it. All right. If it reverses here, then you might want to wait till it gets back down here to a support level Or if the market hits 3,200, whatever happens, at 3,200, and buy more down there, maybe even buy the rest down there.
Got it.
All right.
Okay.
But this might be a good time for the first purchase. What's the next one? Let's look at the weekly.
Sure.
I mean, yeah, the weekly chart, long term. All right. Again, 230, 35 up here looks like the high.
Yep.
All right. So it's actually got some room to move. You can make a nice profit in there, and then also get the dividends as well. So this one looks like it's actually trending down on the long term.
Yep.
So if you mentally draw a line from this low right here down to this low right here, you can see it's a downtrend line.
Sure.
So you want to see, again, you want to see if you can get through that 50, that 200 day. If it doesn't, it starts to decline more, then see if it breaks through that next level, which is around 150.
Gotcha.
Right. What's the next one?
STEM.
Oh, STEM.
Yeah, it's one I
This
accidentally bought.
Yeah, you still have it, right? Did you put
a
stop?
Yeah, there's a stop. Yeah. Yep.
At your buy point?
I think 10 cents above my buy point, I think.
All right, you're still in it, but could get stopped out next week.
Yeah, maybe.
So here's STEM. So STEM is not a long-term hold. It's a I'm trying to think of the right word. It's, you think it's got good potential and it might continue higher, but it could do anything really.
Yeah, of course.
STEM it has a really good business. So I think when the economy starts to improve, when the market starts to improve, I think STEM is going to have a strong showing as a result. And the other thing I noticed on this is, as it's come down the last 3 days right here, the volume has been drying up, which is a good thing. That's what you want to see when it's declining. You want to see, not many people really want to sell.
Got it.
So they're hanging in there. So you own STEM. I wouldn't do anything more with it until it can break out above the 21-day and the 50-day, which are basically, both of them are real close to each other right there. So the 50-day is at 1457 and the 21-day is at 1418. So I'd give it like 1475. If it gets above that, then you might want to add some more to it.
Okay.
So it's a kind of a new stock. It just came into the market back in 2020. Had a huge run, came back down, started to go lower, and then started back up again. Had a really good earnings report, the last report. That's why I had this really strong showing right here. I'm not sure when the next earnings is, but it's probably coming in the next 3 weeks.
I would think, yeah.
Right. But you want to see it get above this 200-day. This is actually a 200-week, 200. No, it's a 200-day.
Okay.
Right there. So you want to see it get above that gray line. So STEM is, I just say hold. I wouldn't do anything with it right now and just keep your stop in. You could get stopped out, but it's okay. I mean, if you get stopped out and you still want to go back into it, you can always buy back later.
There you go. Next one is,
by the way, on that topic, because some people want to be right in the market, and the stock goes down and they're like, no, I'm sure I'm right. I'm going to just keep it.
Nah.
It's okay to sell it and take a small loss. And if it keeps going down, if you still like it, if you still like its story, you like the company, you like the earnings, just buy it again. There's nothing wrong with that.
Yeah.
What's the cost of buying and selling a stock? Yeah. The cost used to be, years ago, was $100 every time you made a trade.
Yeah.
What's the cost today to make a trade?
Nothing.
Zero.
Yeah.
Right?
Yep.
All right, what else?
TOL, T-O-L, Toll Brothers.
Toll Brothers. All right, so this is one that, the relative strength looks pretty good. It kind of made it above its weekly, but then started back down again. The accumulation distribution line was falling below its moving average, which means institutions were distributing. They were getting rid of it, which is apparent in this sell-off right here.
Yep.
But then it started to recover, came back up, hit the 50, and then got rejected on Friday and started to come back down. Yeah. So this is one, and also the momentum indicators here are overbought. You can see how this is at its peak and starting to roll over right here.
Yep.
So this is not the time to buy Toll Brothers.
No, just watching.
This is not one that I would buy right now. But if it's one that you like, I would wait for the momentum indicator to get near the bottom, like they looked right in here when it started this uptrend, and then buy it when it gets down there like that again.
Okay.
Now the long-term weekly looked like 75 was its high over the last 5 years. So it's pretty dramatically below that. Everything else looks, reasonable actually. The momentum indicator here is just starting to turn back up. Remember, this is a weekly, so it takes longer for these things to move.
Right.
And you can see that the weekly bar right there actually looks pretty positive for last week. But you want to see it, prove itself a little bit more before getting in. What else?
Right. Let's try Norwegian Cruise Line.
NCL.
I think so.
NCLH. Okay, Norwegian does not look healthy.
Good.
This is not a good one. Here's the 200-day way up here, the 50, the 21, it's below both of those. It's actually tried to make a run for it, but it's kind of like getting rejected there.
Yeah.
This is one that does not look great to me. Awesome. Its industry is underperforming. It's actually outperforming its peers, but its industry and its sector are underperforming. These are like secondary ones that I look at. After I look at what the chart looks like, the chart to me does not look very healthy.
Sure.
This is one that I probably would stay away from.
Awesome. Okay. Apple.
Apple. Everybody's favorite. All right. So Apple, what was Apple's announcement? It was not going to open a new manufacturing.
No, so again, as you know, Apple doesn't actually announce anything. It was reported that they were reducing expectations for iPhone deliveries by 6 million.
Right. Yeah. And this Apple, everything about Apple doesn't look good.
Yeah.
By the way, one guy on CNBC that I respect, his name is Carter Worth.
Yeah.
He's a technical analyst. You might have seen him before.
I have.
He did a special on Apple way back here. Did you see that one?
I did not. I'll look it up.
He did it way back here in August, probably August 15th, right around that time frame. And he drew, it was pretty interesting. Let me show you what he drew. Make this blue. So he drew a channel line, something like this. And it was about here. So it wasn't quite at the peak. And then he drew another one looking like that.
Oh.
That is a bearish wedge.
Got it.
Very reliable pattern. You can see it's trading up into the peak of the wedge. Right. And remember, he showed this right around here on the 15th. Right.
Yep.
And his headline was, "Sell it all now."
Oh, good for him.
Sell it all now. I actually bought puts on Apple.
Oh, there you go.
Right in 3 year.
That was profitable.
Puts. Yeah, it was a nice profitable trade. I sold them when it started to have a little recovery right here when it hit the 21-day, which is a reversion to the mean.
Sure.
But they were December puts. I mean, if I still held them, I'd have a huge profit.
Yeah.
But this was a really good call on his part. And it was pretty obvious, actually. I mean, all the other folks on CNBC are like, well, you can't say that about Apple. Apple, it's strong. They always recover.
Blah, 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 blah. Yeah.
Because I don't care. Because I rarely ever say this, but I'm telling you, sell it all now.
Yeah. There you go. I'm going to look that up. Well, let's do JP Morgan now, because I got some place to be. So let's do JP Morgan in the risk calculator.
Okay. Yeah. What time is it? We've got 2 minutes.
I can go probably 5 over, but not much. But yeah.
All right, JP Morgan, you bought a little bit there. It's been declining, so it hit its reversion to the mean, the 21-day, and got rejected. It's heading back down.
Which is good.
All the indications, the industry is underperforming. It is actually keeping up with its peers. So it's doing pretty well against its peers. The industry is underperforming its sector, but the sector is outperforming the S&P.
Yeah, and if you, as you know, but for the audience, JP Morgan reports Friday. I only bought my first tranche. I hope to buy more, so I don't necessarily want it to go up.
Okay. So with that in mind,
sure.
Let's look at this, because that's a good thing when you're looking at something that's going into earnings and trying to decide whether you should buy it or even hold it. The thing that I look at is this blue line in particular,
okay,
and the accumulation distribution, which is up here. So is Wall Street accumulating? Because Wall Street has meetings with executives, CFOs. There's a quiet period before they announce. But before the quiet period, Wall Street's having meetings with them, and they have a sense of what's going to happen. That's reflected here in this accumulation distribution, and it's reflected here in how they're doing against their peers. The JP Morgan is hanging in there. I expect that the earnings will probably will not exceed, but will meet earnings.
Yeah, well, I think there's going to be a lot of companies, especially in the finance, that really set negative expectations.
Right. And I think the forecasts will be
weak,
negative.
Yeah.
And if we look at the long term right here, you can see they've just been trending lower, and it can't get through this blue line, which is the reversion to the mean. Gets up there and gets rejected.
Well, I hope to buy under 100 this sometime this week.
I think you might have a really good shot of doing that. So let's take a look at the risk calculator for a second.
Yep.
And I'll go through this pretty quickly. We could do another session on this in more detail later. I'm looking at some way to make my newsletter easier and actually put more content in there, like putting things in, like some of my scans where I scan for things on a daily basis. Maybe on a daily basis, give folks a list of stocks that might be good potential purchases, but I can't really do that in the newsletter. So there's a lot of things about the newsletter that I can't do the way it's designed right now. Okay. But once I do that, then I'm going to probably do a session on the risk calculator. So the way this works, I've got it set up for 3 different accounts. You can just use one of them if you want to. You can use 2 different accounts, or you can use 2 different stocks. In this one, we're going to use JP Morgan. So I put that right up there. I can click here, and it will take me to a chart of JP Morgan. And the key thing that I want to know, so there's the channel JP Morgan is in. The key thing I want to know is the ATR. What is the average true range of JP Morgan? What's the range that it travels in a one-day period?
Yep.
It's $3.34. Okay. All right. So that's important because I put it right here under ATR, put $3.34. So that's its average range. What's the price that you bought it for? Do you remember?
Yeah, 104.40.
104.40. All right. So 104.40. Put that here. There's a lot of things to this. So you could say, I think it's going to go up, but I want it to prove itself. So 104.40 is where it is right now, but I want it to go up by 1% before I buy. So you can put 1% in there, and down here will tell you the price to buy at if it gets there.
Gotcha.
Okay. But in this case, you bought it for 104.40, so we'll just make that 0.
Okay.
Okay. Now I can use a percentage stop. So let's say I want to put a stop up. What did you use? Do you have a stop on it?
I did not have a stop on this one. I was hoping to add more. I did not put a stop.
All right, so let's put 7%. And that's a big no-no, by the way, buying a stock without this. But in this case, you actually expect it to go down. So a stop would just take you out where you actually want to buy more when it gets down there. But if you put a 7%, then your stop price would be 97.09.
Okay, makes sense.
Okay. But if I want to put a actual dollar value for my stop, one thing that I've done to help with that is I've taken the average true range of $3.34 and I multiply it by 2, so $6.68, and I use that as my stop. In this case, 97.72, which is actually a little higher than this one. So if I want to do that at 2 times the average true range, I put 97.72 in there, and now my percent stop is 6.4%.
Makes sense.
See how that works?
Of course.
All right. So that's what I'm buying it at. I got to put $100,000 for your account value.
100 grand. Yep.
So that number will change all the time up here. You know, as your account values go up and down, hopefully up. You continue to change that, so your next purchase might be a different number, and you could do that across in these other 2 boxes if you want to. Gotcha. One thing that I do is I'll look at maybe 3 different names, and I'll put all 3 in there, and I'll do the analysis down these, and then I'll save this with those 3 symbols in the title of it when I save it.
Makes sense.
So then I can go back to it later and see what I actually did.
Cool.
All right, so now in this case, it says I can buy 90 shares, regardless of which one I choose. I can do the 7% or the 97.72 hard dollar.
Yeah.
I can buy 90 shares. That's all I can buy.
Mhm.
So if I want to scale in 50% initially, I can buy 45 shares.
Okay.
And you bought what, 20?
20 shares. Yeah.
So yours is probably like 25%
Yeah, roughly.
or 20% or 22%. There you go, 20 shares. All right, so you bought 22% initially, so you got 20 shares. And now your scale-ins can be either, let's call it 10% below. Let's say you want it to go down 10%.
Yep.
Minus 10%. So your next buy point is 93.96.
Yep. Okay.
All right. And if you want to just buy all of it the next time, I'll just take that second one out. So now you're going to buy 70 shares at 93.96.
Like it. Yeah. My intention with this, again, just one guy's attention is probably 3, maybe 4 ladders into this. And that I rounded it up to 100 shares would be my total acquisition. So we're close. Yeah.
So let's say you wanted to go down 10%. Again, we got to widen these things so it shows that. But
yeah, no problem.
there's another 10%. So now it's 93.96 is your next ladder in, and your next one after that is 84.56.
I like it.
Or you could ladder in here at 93.96, and then you say, well, I think now it's going to start going up. So now when it goes up 5%, I'll ladder in my second one. Now it's 98.66 is your next ladder in.
Yeah, this is fun. I love this risk calculator. It's something
And it will adjust
with.
your stop price down here based on all of this. So we kept it at 97.72 in this case, but in the 7% one, we had it at 97.09, but because we changed the basis,
Right.
so now my basis instead of 104 up here is 98.
Right.
In both cases.
Yeah.
But because we're using 7%, my stop price now drops to 91 instead of 97.
I like it.
In this case, we're using a dollar amount for the stop, so it stays the same. But now it's only 0.39 that you're going to lose instead of 7%.
Got it.
And then the last thing about this is up here you can set a profit target. So if I want to make 5% on this deal, it will use your adjusted amount down here. It says you can sell now at 109.62 and you'll make 5%.
Got it.
Or you can use 2 times your ATR, 2 times the average true range.
Okay.
And then it's 98.88. So there's a lot of things to this, but I never buy without running through this process. And usually it's pretty quick because I usually just want to put, I put the ATR, I put the account value, the ATR, I put the price that I'm going to buy at. It tells me how many shares I can buy. And that's the most important thing.
Yeah, money shares. And then again, the thing that I need to get in there is the stops. That is something I learned from years ago that I need to be more disciplined. So thank you for the reminder.
Yeah, and if you're buying it with the expectation the market's going to go down and you want to buy more when it goes down, then try to figure out what you think the absolute worst case scenario is. If this thing goes to $80, do I still want to own it? Actually, you might want to buy more at $80.
Yeah, probably.
So in this case, maybe you don't want to stop. Maybe you're okay. A company like JP is not going out of business, right?
Yeah, my intention over the next 18 months is to build a portfolio of somewhere between 5 and 10 companies that I want to, my theory is when I die, Teresa gets them. That's my theory.
Okay.
I'm not a trader. I'm never going to do the work that you do, but I think I could take a percentage of my net worth, put it in rock solid companies that produce dividends.
All right. So the way that really quick, I know you got to go, but what you just said, you want 10 names. Yeah. This one right here, the account rule. I've got 3 rules that I go by to figure out the number of shares. The account rule tells me I don't want to risk more than 10% of my total account value.
On any one stock.
I'm not risking more than $10,000 on any one stock.
Yes, that's one in my calculation for this.
All right.
Yeah.
So
totally
what that means implicitly is 10 names.
Exactly. No more than 10 names. Yeah.
No more than 10. If you make this 20%, which allows you to buy more shares, I'll change that to 20%. Now I can buy 140 shares, but I can only own 5 names now.
Correct.
All right.
I agree.
The other 2, this one, the trade rule says I will not risk more than 1% of my portfolio on any one trade. Yeah. The only way that works is if you know what your stop price is.
No, absolutely. And this is why I'm not trading. I just don't have it. You and I talk once a week, never when the market's open.
Right.
I just know I'm not doing this. I'm going to try to build 5 to 10 companies that I will hold for decades. Is my
Right.
vision for this.
And then the last one here is the volatility, because the average true range tells you how much a stock can move. So you might have a $100 stock. In this case, is $3.34 in one day, but you could have another $100 stock that could move $8 in one day, like
For
a
sure.
Tesla, right?
Yeah, for sure.
Because it's a lot more volatile. So
Mhm.
that's what the average true range does. And then I put a rule in here that says 1% of that average true range. If then we'll calculate each of these three separately,
I like it.
how many shares I can buy, and it will give me the most conservative one.
Perfect.
So this 90 shares down here is the most conservative of these three rules.
Awesome. Very cool. Well, thank you for doing this with me. This is great. There's a lot of value, lots here. Go back on the playlist. We did some early deep dives on this. People can get them in your playlist. What's your newsletter?
Newsletter is breakpointtrading@gmail.com. Just send me an email. I'd be happy to send you the last week's newsletter and add you to the list for next week.
Awesome. Thank you so much, Dan.
All right, you bet. Have a good
Thanks.
week.
You too. Later.
Bye.
Good luck.